Okay, so if you just caught the headlines on Charter Communications, CHTR, their Q3 2025 earnings, well, they looked pretty rough initially.
Yeah, the stock took a real dive in pre-market. Definitely ugly at first glance.
But then something really interesting happened. The shares actually staged this pretty dramatic comeback. Ended the day up.
Exactly. Welcome to the deep dive, everyone. We're going to unpack that volatility.
Yeah.
It was quite a ride for telecom watchers.
So our mission today, figure out how a company misses estimates, loses key subscribers, but the stock still rallies.
That's the paradox. We need to look at those headline misses, sure, but also zoom in on the wins, especially mobile, and then really get into the long-term story that seemed to, win the market over in the end.
All right, let's start with the pain points. The initial reaction was all about the misses on the top line numbers. Their GAAP EPS, that's earnings per share, using the standard accounting rules, it came in at $8.34.
Right, and the street was looking for, $9.27, maybe even $9.41.
Yeah, somewhere in that range. So like a 10% miss right out of the gate. You can see why people flinched.
Definitely. And revenue didn't exactly inspire confidence either. $13.67 billion. Again, a slight miss, and actually down a tiny bit, 0.9% year over year.
So if you stopped there, that early 5% stock drop makes total sense.
Absolutely. But the narrative really flips when you dig into the actual operations. It's like two different companies under one roof right now.
The contrast is pretty stark, isn't it? On one side, you've got mobile just killing it.
A runaway success, yeah. They added, 493,000 mobile lines just in Q3.
Incredible. Brings our total up to 11.4 million lines now.
So when management says they're the fastest growing U.S. mobile provider, well, they're right. The numbers back it up.
That mobile growth is clearly the story they want to tell. But then there's the other side, broadband internet, the core business.
Right, and that engine seems to be sputtering a bit. They lost 109,000 internet subscribers.
And that was worse than analysts expected, right?
It was. And it points directly to the competitive pressure. Fiber rollouts, fixed wireless access FWA gaining ground.
Okay, wait, let's dig into that broadband loss for a second. Management made a point of saying it was mainly about lower gross additions, not higher churn. Can you break that down? Because low churn sounds good.
That's a really key distinction. Good question. Low churn means the customers they have are sticking around. They're relatively happy, not leaving in droves.
Okay.
Lower gross adds means they're having a harder time signing up new customers. Think people moving or first-time buyers.
So the competition isn't necessarily poaching their existing base as much as winning the jump balls for new customers.
Exactly. It signals a tougher fight for new business, which, frankly, is a better problem to have than a leaky bucket where existing customers are fleeing. It's an acquisition challenge, not a retention crisis.
Yeah, that puts a different spin on it. And then surprisingly, video actually looked better.
Yeah, relatively speaking, only lost 70,000 video subs. That's a big improvement compared to the losses they saw in Q3 last year.
So the overall message from management was kind of, look, competition is tough, we know, but the pieces are working, mobile's great, video's stabilizing, and our eye is firmly on free cash flow, FCF growth.
And that FCF focus, that's really why the stock recovered. You see it when you look underneath the hood at profitability, specifically adjusted EBITDA.
Right, EBITDA earnings before interest, taxes, depreciation, amortization, the core operating profit measure.
Exactly. It came in at $5.56 billion. Now, that is down 1.5% from last year.
Okay.
But, and this is crucial context they provided, Q3 2024 had a ton of political ad spending. This year, not so much. If you strip out that political ad drag, underlying EBITDA was basically flat.
Okay. So flat underlying profit in this environment is actually not bad news.
It's arguably a win, yeah. Shows resilience.
And what about what they're charging? Unit economics seem okay? ARPU?
Holding up pretty well. Residential ARPU average revenue per user was up 1.0% year over year, $122.63.
How are they managing that with fewer video customers who usually pay more?
It's a mix. Standard price increases on step-ups from promo rates, plus, crucially, the growing contribution from adding those mobile lines to the bundle. That's offsetting the drag from having more internet-only customers.
Gotcha. And that links right into the convergent strategy. Bundle mobile and internet.
Precisely. And speaking of other revenue lines, advertising. It was down 21% year over year.
Ouch.
Looks bad, but again, pull out the political ad comparison from last year, and the underlying ad revenue was almost flat, down just 0.5%.
Okay, so the core ad business is holding steady despite the noise. That's good context.
Yeah, it shows that the non-political part is healthy. But back to convergence, that's clearly the strategic linchpin. They said 21% of their internet customers now take mobile too.
And why is that 21% number so important?
Because the payoff is massive. Management hammered this home. Converged customers churn much less on the internet side.
Stickier.
Way stickier. And their customer lifetime value, or CLV, is significantly higher. Bundle customers are just worth a lot more over the long haul.
Makes sense. Now, mobile profitability. That's often the Achilles heel for cable companies acting as MVNOs, mobile virtual network operators. How are they making that work?
Their secret sauce, if you will, is network offload. They're getting really efficient.
Oh.
They said they've cut their reliance on paying the big carriers for using their macro cell towers by 20% over 3 years. And here's the kicker. 88% of their mobile data traffic now runs over their own infrastructure.
88%. Wow. What infrastructure is that?
It's their advanced Wi-Fi network, their own licensed CBRS spectrum. That's the Citizens Broadband radio service, like their private mini network and some partner networks.
So they're not just reselling Verizon or AT&T entirely.
No, far from it. This facilities-based approach, offloading traffic onto their own pipes, drastically cuts their costs and lets them scale mobile profitability much better than, say, Comcast has managed historically.
Okay, this is where it gets really interesting for the stock turnaround. CapEx, capital expenditures.
The money they spend building and upgrading the network.
They actually revised their 2025 CapEx down.
Yeah.
Lowered the outlook from $12 billion to about $11.5 billion.
Yep. And the magic words, the phrase the market absolutely latched onto was management saying 2025 is explicitly the peak capital year.
Peak CapEx. That's huge.
That statement is almost everything for the bull case right now. It's the linchpin of the whole FCF story.
Explain that mechanical FCF step-up idea again.
Okay, so free cash flow this quarter was, $1.62 billion, basically flat year over year. But the point management kept making is that FCF is set to surge after 2025.
Not because of some amazing new product, but just math.
Pretty much just math.
Yeah.
That massive $11.5 billion annual spend on network buildouts starts to roll off. Less spending means more cash drops at the bottom line. It's mechanical lift, almost guaranteed, assuming the core business doesn't implode.
And that provides a sort of valuation floor, regardless of quarterly subscriber wiggles.
That's exactly how the market seemed to interpret it. It anchors the whole long-term view.
Okay, shifting gears slightly. How are they actually fighting back against the competition? Management was pretty blunt about the pressures.
They were quite candid, yeah. Acknowledged the slow housing market, fewer people moving, which hurts gross ads, but also called out the direct competitors. More fiber builds, the rise of fixed wireless. They specifically mentioned AT&T's cell phone internet coverage expanding as a pressure point.
So what are they doing about it? Marketing differently.
They talked about these expression offers, trying to be smarter with promotions like that. 4 lines of mobile means your internet is nearly free deal.
Sounds expensive.
Well, they admitted it targets a small group, but the goal is to snag those super high-value, low-churn customers who take both services. Focus on the quality of the ad, not just the quantity.
And video. Are they still trying to sell cable TV bundles?
Less like that now. The strategy shift is interesting. It's less buy this channel package and more like, look, you're paying, say, $125 for all these great streaming apps we include. And hey, the linear channels are basically thrown in for free.
So video becomes a retention tool for the core connectivity products, not a growth engine itself.
Exactly. Use it to keep people sticky, keep them happy with the bundle.
Now, looking further out, AI management spent a surprising amount of time on this.
They did. And the numbers are potentially huge. They estimate their annual cost to serve, the customer service calls, truck rolls, tech support, is around $8 billion. A massive number.
$8 billion a year just managing customer interactions and issues.
Roughly, yeah. So even small efficiency gains there have a massive impact on margins. They said they've already made progress over the years, but now they're betting big on what they called agentic AI.
Agentic AI. What does that mean in practice?
Think autonomous AI agents handling customer service. Sophisticated chatbots, essentially, but capable of resolving complex Tier 1 issues without needing a human.
Really?
Yeah.
Fully autonomous.
That's the goal. They expect a material impact in maybe 12 to 18 months.
Yeah.
The idea is it improves service quality, makes the human agents' jobs better so they stick around longer, and the big one dramatically lowers those operating costs over time.
So it's an internal efficiency play that could seriously boost profits down the line?
Could be transformative if they pull it off. A multi-billion-dollar opportunity hidden inside their operating expenses.
Okay, quickly on the balance sheet, leverage, debt.
currently sitting at 4.15 times net debt to their last 12 months adjusted EBITDA. Call it 4.23 times if you adjust for a recent Liberty transaction.
And the plan.
Keep it around there, maybe slightly under 4.25x, while the huge Cox Communications deal is pending. That's a $34.5 billion acquisition.
Wow. And after the Cox deal closes, which is expected mid-2026.
Then the long-term target leverage actually steps down. They're aiming for 3.5x to 4.0x.
Interesting. So even with that massive deal, they expect the combined cash flow to be so strong they can actually reduce leverage over time.
That's the signal. Confidence in the cash generation power of the combined entity while still having room for buybacks or dividends.
Okay, let's tie it all together. We had this messy Q3 print, headline misses, worrying broadband losses. The stock had been crushed, down like 28% over the year, while the S&P was up nearly 20%.
Yeah, massive underperformance.
So why the sudden reversal? Why did investors look past the Q3 noise and focus on the long term?
It really felt like a collective pivot. The market just shifted its gaze from the immediate, messy present to the clearer, more certain future. Three things, really.
No.
One, that hard date for the CapEx peak in 2025, knowing that $11.5 billion anchor is coming off the books. Two, the expected benefits, both cost savings and strategic, from eventually closing that massive Cox deal.
Great.
And three, just the sheer predictable cash flow generation that allows them to chip away at debt while still returning capital to shareholders. Those three pillars seem to outweigh the Q3 subscriber number.
And management also argued they have more pricing power left than competitors, right? Especially on the video side.
Yeah, they made that point, suggesting their current spectrum pricing gives them more headroom to pass on costs compared to maybe a Comcast or a Verizon, adds a bit more resilience to that FCF outlook.
So the market discount was basically pricing in a scenario where broadband never stabilized, but the CapEx cliff and the guaranteed FCF jump just created too strong a floor to ignore any longer.
I think that's a perfect summary. The mechanical FCF lift became undeniable.
All right, that brings us to our favorite segment. This is not financial advice. We take this strategic pivot point and cook up a slightly outrageous, but maybe plausible trade idea.
Let's do it. This one is based entirely on buying into management's conviction. Internet subs will stabilize eventually, and that FCF step-up is locked in.
So the trade hinges on betting against the short-term noise.
Pretty much. The market's worried about subs today, maybe not focused enough on the cash gusher coming in 2026 and beyond. So the idea is a bit complex, uses options.
Okay, lay it out.
You go long charter, but not by buying stock. You buy long-dated, deep-in-the-money call options, maybe dated 2 years out, something like that. Gives you leverage to the upside.
Okay, but those are expensive.
They are. So you help finance buying those long calls by selling near-term options, selling puts, selling calls maybe 3-6 months out. You're essentially selling the current volatility, the near-term uncertainty premium.
So you're betting the stock won't crash in the short term, collecting premium for that bet, and using it to fund a longer-term bullish position via the deep-in-the-money calls.
Exactly. You're betting that the current discount, the underperformance versus the sector ETF XLC, for example, is overdone. The trade aims to capture the FCF growth accelerating faster than maybe the street models today, driven purely by that CapEx rolling off and the deleveraging story post-Cox.
It's a value play dressed up in options, focused on that capital cycle inflection point, using the structure to amplify the gains if the FCF story plays out, while trying to offset the costs using the near-term jitters.
Precisely. Maximize exposure to the eventual FCF multiple expansion, minimize the upfront cost and pain from any bumps in the next few quarters' sub-numbers.
Okay, that definitely qualifies as plausible but outrageous. Remember, folks, not financial advice.
Definitely not, just thinking through the implications.
So wrapping up our deep dive on Charter's Q3, a really mixed bag, wasn't it? Great mobile scale, video holding its own, but that broadband pressure is undeniable.
It is, but the market's verdict driving that stock rally seemed pretty clear. Focus on the future catalysts, the CapEx peak coming, the Cox merger benefits down the road. Those became the dominant narratives.
Which leaves us with one final provocative thought to chew on. Management spent a lot of time talking about agentic AI potentially revolutionizing their $8 billion cost to serve. So the question is, how much value is the market actually pricing in for that? Are we also hyper-focused on the 109,000 subscriber loss this quarter? That we're completely missing potentially billions in future margin expansion driven by AI optimization. Is that the real hidden value here?
That's a great question to ponder. How much is that future efficiency worth today? Something to keep an eye on.
Indeed. Something to mull over as we head into the next quarter. Thanks everyone for tuning in to the deep dive.